FEGLI Group Life Insurance. How does it work while you're working? Well, let's talk about the three options first. You have option A, option B, and option C. Let's cover option A first. It's a flat $10,000, and when you go to retire, it will automatically reduce by 75%. And how much will you have left? $2,500. That's it. It's relatively inexpensive because it's relatively little payout in the form of life insurance. Let's talk about the option C. We're going to go past the B because we're going to talk about it in more depth. Option C, five options. It's family coverage. So it's not for you, it's for your spouse. So one option is worth $5,000. Five options will be $25,000. Now, oftentimes I see federal employees use this for their spouse if their spouse is really, really bad off health-wise and they couldn't get life insurance anywhere else and they've tried. They keep the spousal coverage. Now, some of you may not even be married and you have this. If your kids are under age 22, then they'll get $12,500, half as much. For each option, $2,500 if they passed away. Or unless they're married, then it would stop that coverage on your children. And if they're disabled, it would go beyond age 22. Now let's talk about your option Bs. Those are the biggest options you have. And why? Because they have a lot of life insurance, because it'll round up to the nearest thousand based on your pay. I should tell you that you have to have basic group life insurance to have any of the options. And most of you do. And honestly, you should have the basic. So if there's ever an open season and you can keep it for at least 5 years, you'll be able to keep it into retirement too, and you'll do a 75% reduction. Most people do that. Anyway, the basic is paid for by your benefits package. 1/3 is paid to who? To MetLife, inside of your benefits package, because the federal government is not a provider of group life insurance, are they? No. So that goes to a private company. So in this case, let's illustrate. Let's say you make $139,100. So your options will always round up to the nearest thousand. And so in this scenario, you would make, or you would have per option B, $140,000. Now you can get as many as 5 option Bs, and so you could have as much in this illustration, $700,000 term life insurance. For how long? Well, it's a 5-year term in your group life insurance. What does that mean? Every 5th year, the price will spike, particularly at 45, 50, and especially 55 and 60. Would you like to see that? If you go to FEGLI calculator and Google it, OPM has a site where you can calculate the premiums. And in this case, 140,000, 5 of these guys would be 700,000. At age 50, you notice that the premium is $70 a pay period. Still seems reasonable. Times 26, divide by 12, $151 a month. Not so bad, you say. But at 55, it becomes $126 or $273 a month. Look what happens at age 60, where the premium almost clocks you over the head. It's $280 a pay period or over $600. See, there's $606 per month. If you try to retire with these options, it will inevitably eat up your retirement paycheck. It explodes in cost. So if you need life insurance, why not examine how much you need and figure that out and get it for at least 10 or 20 years if you're going to get that. Now, I'm often asked, Charles, what do I do if I have all these options? First off, examine them to ascertain if you need life insurance or not. And then explore your options in the outside world. And then thirdly, once you do ascertain if you need it or not, if you're going to replace that life insurance, then you can always eliminate your options at any time. So you do not need open season. You can eliminate your options anytime you want to. I like basic, and I would advise that you keep it. If there's ever open season, you can sign up and get basic for 5 years. If you keep it, then you can take it into retirement. Most federal employees, they keep 25% of that basic. Okay, this is Charles Dzama, empowering you with financial ideas.